Welcome back, everybody. So, in today's video, I want to talk about how an ICT student would approach the calendar and how we would trade this calendar according. Now, each week we'll have a different set of news events. Some weeks will have a lot of red folders, which, if that's the case, then that's going to be a week that you're going to work inside of like a minefield. And if you're trading that week, then you're going to look to trade intraday session liquidity. This was covered a couple of videos back. We specifically had a week where we had a whole bunch of red folders, no clear directional bias on the daily, and we would then just look at taking trades on session liquidity, which means you basically utilize the hourly, the 15-minute, and your highest time frame would be a 4-hour chart. You would be looking at those going down into a 5, 3, 2, or a 1 minute, or even as low as 30-second charts if you like doing that. And you would execute based on that liquidity. So let's look at how you would trade some intraday, intra-session volatility. Let's first look at last week's calendar. As you can see, we had Thursday, we had PMI. We had FOMC meeting minutes on Wednesday PM session. So ideally, Monday, Tuesday, and Wednesday morning, up until after the FOMC minutes release, you're most likely going to look at staying out because you're going to get sideways. It's going to be high resistance liquidity runs. And we also had Fed Chair Powell speaking on Sunday, which is not a red folder, but that adds an extra level of erratic, choppy, messy price action. But the main factor here is we have FOMC meeting minutes on Wednesday, and this was 2 p.m., which that would be classic PM session. So ideally, Monday and Tuesday, I expect some type of chop, smaller range. I expect an expansion move. Wednesday, I expect price to get volatile, really expand. And FOMC tends to trade in two moves. ICT explains this as well, and he says that we could expect the first move, which is usually like a Judas swing at 2 o'clock, and at 2:30 we can expect the second stage of the distribution, which would most likely be the real direction that they intend to take price in. So last week, if you were trading, you were going to look at trading after the FOMC minutes. And on Thursday, we have PMI 945. So preferably you would look at trading after the first 30 minutes of market open, which would be 9:30. So we would look at taking something around 10 o'clock. So that gives the market time to play out. We can see what we get for the open. We can look at the opening range gap. We can utilize that in our analysis. And we can form some type of an idea around that opening range gap. On Friday, we had 10 a.m. revised UOM consumer sentiment, which on Friday, you would expect a volatility injection around 10 a.m. Usually the red folders that are around 10 a.m. are usually not that heavy volatile. So they might inject some volatility, get the market moving around the 950 to 1010 macro, but I don't expect anything major. That's usually the case. Most of the time, you will get your high impact news events around 2 p.m., which is usually FOMC. And then you're going to get PMI, which is usually around 9:45. And then you get your NFP events, which are on the first week of every new month. And that one is going to be at 9:30. So usually around 9:30, you tend to get a lot of more volatile news events. And sometimes you get a couple of them around 8:30. So looking at this calendar, Monday, Tuesday, and Wednesday morning, I'm staying out. Wednesday afternoon, after FOMC, after that first move, you wait for 2:30, you go in. You might possibly find a trading idea. And then, of course, Thursday, right after 9:45, maybe you get something before that. Perhaps you're going to get something after that. So that's tradable. And then on Friday, I would say if you're trading around 8:30 or 9:30, then that would be perfectly tradable, just because we don't really have any high impact news events. And around 10 a.m., most likely what's going to happen is if you did not get anything around 8:30, didn't get anything at 9:30, then the market will probably move around 10 a.m. because I don't expect that to be a massive news event. So let's jump into the NAS, and we are looking at a 15-minute chart. And as a example, let's quickly just look at this week's price action. Let's just take a look at what happened on a 15. So starting out, there we go. Sunday opening, we had a consolidation. Market traded down into this fair value gap. And right at the bat, 9:30 opening Monday morning, it blew up, trading higher. Monday morning, we had FOMC member Waller at 9 o'clock. So 9:30 could be a viable trading scenario. Now, this is the part where a lot of people will ask you, but how do I know which Mondays in a week with a lot of high impact news events? How do I know the market will give me a low resistance liquidity run on that specific Monday? And the answer is that you really just don't know. Because a lot of the time, and a lot more times than not, on a red folder week where we have a whole bunch of landmines, it's going to be more likely for them to give you a high resistance liquidity run, which means the market will be messy, it's going to be choppy, and yes, there will be weeks where that particular Monday is going to trade crystal clear, low resistance liquidity runs. But more times than not, it's probably going to be a high resistance liquidity run. It's going to be choppy, it's going to be slow, and it's going to eat at your mental capacity. So that's something that you have to backtest with your particular model, and you have to look at your data and you have to see if it's beneficial for you to include trading on a Monday as a general rule. And you have to look at weeks where you had landmines with lots of red folders and no real higher time frame bias. You gotta go look and you gotta go see if you had any trades taken in your backwards and forward testing, as well as your tape reading in your journal. Nobody's really going to be able to tell you if it's going to work for you or not. You're going to have to sit down, you're going to have to go do the work, and you're going to have to mark it up, put it in your journal, and you're going to have to look at the data. And more times than not, it just depends on what your data tells you. You might be trading, as an example, let's say that you trade an order block. And what you found with your back testing, and maybe you were trading, let's say you were trading the 1050 to 1110 macro, just as an example, honestly. And you found that a lot of times on a Monday that particular model will present itself and it will give you a stunning 5-handle trade. More weeks than not. So in your particular case, it would be beneficial to trade on a Monday at the 1050 to 1110 macro, because the back testing and the data that you have collected shows you that you will be able to get your 5-handle run, and then you're done for that particular Monday. So honestly, that is something that you will have to go back test, and you will have to go and see whether it works for you or not. In my own back testing and my own studying, I have found that staying out of the marketplace on a Monday, as a general rule of thumb, is more beneficial to me, because a lot of times, most of the time, 80% of the time, my model does not form on a Monday. So it's just a waste of time for me to come down and sit at the desk and sit here, and I spend 2 hours sitting down here being patient, waiting for a possible trade that could form, and at the end of the day it doesn't form, and price action might just be slow, it might just be a lot of high resistance liquidity runs, back and forth price action. And at the end of the day, even if the model does form, then it's not even worth it to take that trade, because you're just spending your mental capital on a Monday. First day of the week, you're spending all that mental capital, and you've got salad days, which usually good days to trade are usually Tuesdays and Wednesdays. And sometimes Thursdays could be added to the mix. And there are times when Fridays are pretty good as well. It depends on the weekly calendar. It depends on the specific news event that's coming up on that specific day. So there are a lot of factors that come into play that really decide if you're gonna find a setup or you're just not gonna find a setup. So just as a general rule, I have found more times than not that it's just not worth my time to trade on a Monday. Even if my setup forms, even if it's perfect, even if it's a low resistance liquidity run, more times than not, the setup's not going to form. It's going to be high resistance liquidity run. It's just not going to be worth my time. So I just generally skip a Monday. Now, times when you could sit down and you want to study the market on a Monday, that would be during NFP week, okay? The first week of each month, of each new month, you're going to get the NFP release on the Friday. So generally then a Monday would be a trading day as well as Tuesday, and usually you would be done on a Wednesday morning. You would not be trading on that particular Wednesday afternoon. You would not be trading the Thursday, and you would not be trading the Friday. And again, there would be another exception to the rule. If you sat down on Friday and you were watching price, and again, this is going to be the exact same thing that applies to looking at a Monday. Right after the NFP release, which is usually around 9:30. And in fact, let's pull up a NFP week. Here we go. April 28th up to May the 4th. You can go find that on forexfactory.com and you can go look at this as well. You can see on Monday we did not have any news events, which is usually typical. We don't have any news events on a Monday during an NFP week. On Tuesday, we had a bit of a PMI on a yellow folder, which I wouldn't be too worried about that. I wouldn't be too worried about consumer confidence. But what's happening right here is you got news events at 8:30. You got something at 9 o'clock. You got something at 9:45. You got something at 10 o'clock. Your important ones are 8:30 and 10 o'clock. Okay, there you go. You got two red folders within the AM session. And that just tends to make that particular session more challenging, more prone to be high resistance liquidity run if you want to trade that. Wednesday morning, 8:15, 9:45, 10 o'clock, you got PMI. And then at 2 p.m., you had the FOMC state federal funds rate, and 2:30, you have the FOMC press release conference. So this is erratic. So likely what would happen here is Wednesday morning, this is going to be chop, high resistance liquidity run if it's gonna move, if they're not going to hold this inside of a range. And then they're going to clear both sides of that range with the 2:30 FOMC press conference. At 2 o'clock, bam, it's going to shoot out the range, give a Judas swing, and 2:30, you're going to get the real move once they've knocked everybody out, and it's just going to run for the liquidity. So both sides of the marketplace is going to be cleared before they run it. So that's a likely scenario of what could happen there. And Thursday, you have unemployment claims. You just don't want to trade on Thursday because a lot of people are going to be anticipating non-farm employment change, NFP. A lot of the money is sitting on the sideline. People are waiting. They're waiting. They want to see what's going to happen. And then they're going to go in and they're going to trade the non-farm payroll. That's what's going to happen. So on Thursday, a lot of people are not going to be in the market. They're just going to be waiting. They're anticipating this news release. They're waiting for that. And at 10 o'clock, you have PMI. So if, very big if, you did happen to sit at the chart and let's say you were looking at the release at 8:30 and you waited up to 10 and the market started cleaning up, and around 10:50 a setup presents itself and you have a clear one-sided draw on liquidity. Market gives you market structure shift, and for the sake of this example, let's say that the market gave you a 2022 ICT mentorship model, which is a fair value gap entry. And let's say we had 15-minute equal highs and we were gonna long that idea. And DXY was tanking down, targeting some old lows, and we had ES, NAS, and YM looking for higher targets, and the market was in symmetry. Then that would be a day where you would be able to take that trade. But again, as a general rule, it would be better to sit on the sideline, as it's most likely going to be job and it's going to be sporadic movement. It's going to go all over the place. And what's going to happen is that is how you end up blowing your account, because you're going to overtrade. You're going to see something, you're going to jump in, you're going to see something else, you're going to jump back in. So it's just a general rule to stay out. And that just, it gives you a higher probability of being a trader with a higher win rate by just completely ruling these very well known beforehand low probability days. You just say, okay, I'm not going to go in on these days because it's low probability. It's a known fact that more times than not, it's going to be a low probability. So I'm just not going to go in there. Rule number 1, capital preservation. That's it, capital preservation. That is your number 1 task as a trader. You want to preserve your capital. If you don't have capital, you cannot operate. You need capital to operate. And that right there is what separates your consistently profitable traders with a trader that might be a consistent break-even trader, is that these guys have sat through more of these high resistance liquidity run conditions. They know how to identify them. They know how to expect them by looking at the calendar. Look at your week. If you got a red folder week, you know, okay, price action might be a bit sporadic. It might be all over the show. I might get a trade, but it's probably going to be something that's going to be high resistance. So I'm going to have to go in and I'm going to have to scalp that. Because if you got a minefield of a week, then you're going to go in there and you're going to have to scalp that particular week. You're not going to expect home runs, and it's going to keep on going, baby. It's going to keep on going. It's not going to keep on going. You're going to get 5 handles. If you're really lucky and it's a really clean run, then you might get 10. But that's going to be that. You're not going to go in expecting a lot. You're going to go in with reasonable expectations. And then what are you going to do? You're going to say, okay, good. This is a week where I got a lot of red folders ahead of me. So if I do end up taking any trade, then I'm going to have to go in with a lower risk percentage. I'm not able to go in with my maximum risk percentage that I would normally want to go in with. You're going to have to limit yourself, and there's going to be specific set rules that you need to follow them. There's no questioning them. You have to follow those rules each and every time before each and every trade that you take. That's what it is. It's a game of rules. And capital preservation is number one. You're always trying to preserve your capital as a trader. You're not going to go in there and you're going to expect home runs. That's not going to happen. It's just not going to happen to anybody. Nobody ever just jumped in right out of the bat, took $1,000 and just bam on a couple of trades. 1 or 2 trades, he made $1,000, $2,000. He doubled the account, tripled the account. It doesn't happen like that. That's horse shit. Doesn't happen like that. You're going to go in with reasonable amounts of capital. And if you're going to be somebody that's going to go in and you're not able to put in $10,000 into an account and start trading that, let's say you've only got $2,000 that you can put in. If you only got $2,000 that you can put in, you're going to go ahead and you're going to go and open an account with a real broker, and you're going to be trading. You're going to be trading micros. You're not going to be trading mini contracts. You're going to be trading micro contracts. Way smaller than mini contracts, which means you're going to make less money, which means you're going to be risking less money. See, that's the thing that a lot of you just don't want to hear. I'm going to be making less money, baby. See, but that's the thing. With more money comes more emotions. So how the hell do you want to manage 5 mini contracts if you're not even able to handle the fluctuations that the market provide you with 2 micros, and you want to freak out? Feels like your palms are sweating. Feels like you want to stand up in the chair because you're nervous. Feels like you just want to get out. You want to get out. You want to get out. It just needs to run so you can get out. See, that's the thing. You're going to be starting out backtesting. And you're going to do that for a consistent 6 months. And you're going to journal everything that you see. You're going to spend hours journaling that. And then you're going to start forward testing. And you're going to journal 6 months of that. And then you're going to go in a demo account. Before you go into a demo account, though, that's where you're going to be tape reading. You're going to first start doing tape reading. And as you sit down and you watch price live, and that's where you're going to need a demo account so you can watch the price action play out live. You're not pressing any buttons, folks. What you do is, let me go ahead and show you on this. You're going to go take a line tool as per example, and hypothetical, let's say this is going to trade lower over here, and then you take your line tool, and that would be your hypothetical entry. You would have a hypothetical. You could just, honestly, if you're using trading view, which everybody most likely is, you're just going to do the short indicator. You're going to place a stop. You're going to place a take profit. And you would manage that position as if you were inside of a real trade. That is what you would be doing. And that is tape reading. Tape reading is sitting there and waiting for your model to present itself. And you then take the hypothetical entry, you mark that, and you look at where the hypothetical stop would be, and you look at where the hypothetical take profit would be. Now, all of these levels are predetermined. Before you even get into that trade, you're going to look at, okay, what's my risk going to be? If I get an entry at that fair value gap, what would the risk be? Okay, it's traded into a higher time frame PD array. We are bearish on a daily. We had SMT with Dow making a higher high, and NASDAQ and ES were unwilling to make the higher high. So price trades down. Price gives you a market structure shift. It trades down with a lot of volatility, giving you propulsion. Price gives you a valid market structure shift. Bam, that gives you a fair value gap. You mark out the fair value gap. Okay, let's see. If I took this fair value gap, what else do I have around here? Do I have an order block overlapping? Do I have a breaker block overlapping? Do I have a inversion overlapping? Do I have a balanced price range overlapping? So those are factors that you look at, and then you know, okay, so I can put my stop loss there. I can put it there. If we go through that level, then we have invalidated 3 PD arrays. So most likely then price is going to hit your stop, and that trading idea is not going to work out. So you would then be looking at scaling out of that trade, because it's going to be more likely that it's not going to go in your favor. Price does not even have to take out 3 PD arrays. Doesn't even have to hit that stop. When price starts trading against you and it takes out 1 PD array, okay, let's see what happens. Do I lose a second PD array? Usually if you lose that second PD array, chances are that price is probably going to hit your stop, and you're going to lose the third level. So look at scaling something off. Take something off. Oh, but why do I want to take something off? I'm in a loss. You see, you need to change your thinking, and you need to start thinking about, I need to preserve my capital. So if I take half of this position off over here, before it's running to the stop, before I lose that third PD array, then the loss that I would take is going to be smaller, which in turn the next trade that I take, if that's a winner, then it's pretty easy for me just to make back what I lost and make a profit on top of that. See, that's how you need to think. You need to be thinking about preserving your capital at all times. So you kill half of that position and you still have the other half on the board, which, if they hit that, take that out, then okay, no big deal. You're going to take losses. It's part of the business. You're going to take them a lot of times. But there needs to be rules that need to be in place for you to control those losses, and you need to know when you're going to turn it off and you're going to walk away and you're going to be fine with going home with a loss. And it's not going to keep you awake at night. You're not going to be laying in bed wondering, oh gosh, man, I lost today. I took a loser. You're not going to be worried about that because you're managing that risk. So even if you did lose, then okay, did I follow my rules? Yes, I did. Then there's nothing for you to feel bad about. Sometimes it happens. Sometimes you could stop prematurely. And the market turns back around, continues going in your favor. And if everything is still valid, you go through your checklist. If everything is still valid, the trade is still good, it's still sound, the logic is in place, you take another entry. And the trade ends up running. And you take your partial, reduce your risk, bring your risk in profits, cover your costs, cover commissions and fees. And it hits your take profit. And what you lost by taking that first loss, you've made that back. No big deal. It's part of the business. It's just another day at the office. So it's important to think about capital because that's rule number one. So you're not going to be going in with 2,000 and you're trading minis and you're expecting home runs. You're going to be trading your minis and you're going to be trading them consistently. And let's say you go in and if you take a mini, you got a stop size of about, you're going to have to go into trading view and this is going to be for your own study. If you take an entry short and let's say you have a stop on, it doesn't matter if it's NQ or ES. If you take the short indicator and you plot that on the chart and you pull that stop loss up to about, let's say you do about 8 or 9% at most. In fact, let's go ahead and do that over here now. Let's just say that we're shorting, let's just put that there, okay, as an example. We'll bring it over here. So this is the entry, so this is my stop loss and that's the percentage. So let's say, okay, you're looking at risking about, and remember, this is a 15-minute chart, by the way, so keep that in mind. Let's jump into a 1 minute for the example. Let's say, okay, you were short and 4, 5. Let's say you were around about 9, 5. Okay, that's 5%. Let's say 9%. That is 16.25 ticks. That's about 4 handles. That's about 4 handles. You get about four ticks equals 1 handle. So that's about 4 handles that you would have as a stop. And then you are targeting, let's say you target for the sake of convenience, you would be targeting 10%. And that would give you around about almost 5 handles. We can just go over to the ES. If you want to check, ES gives you the handles if you wanted to know exactly. See that? So it would almost be about 5 handles. See that? Just shuffle this over a little bit so I can get some more room to show you guys. So looking about, you see that about 10% is about going to be about 5 handles. Okay, so just look at ES if you want to know the exact handle number. So you're risking almost 5 handles. Sometimes you might risk between 8 and 9. And some of you are going to say, oh, but that's such a big stop. I can't risk 4 handles. And see, that's where you're wrong. If I go in with a 1 micro size, and I'm risking about 8%, which is 4 handles, or I risk 9, which is about almost 4 3/4 handles, then if I take a loss, it's not going to be the end of the world, because I mean that's probably going to be about 50, or I think it's probably going to be about 50 or 60, 70 at most. $70 at most for a loss. Okay? And if you take your bank and you make your 5 handle run, and that's probably going to give you about I wouldn't say 80, but I would say maybe 70 or around about there for a take profit. So even with a 1-to-1, all right, with a 1-to-1, if you are consistent, and you will know when you did all the work and all the journaling and the tape reading as well as the demo trading, and you journal all of those results and you followed your model, then on black and white, you go look at those results and you will see if you're profitable or not. If you're profitable and you take 1-to-1s, even with your losses, you will still come out the other end being a profitable trader, even if you are 40% profitable. If your win rate, if your strike rate is 40%, you are profitable. There's nothing to feel bad about if you are doing 4% a month. If you have a strike rate each month going, by the way, not 4% on your account, but if you go in, month out, and with all the trades, all the winners, all the losers that you've taken, and your strike rate is 40%, and you're following your rules, you're doing what you should, then you will still be profitable, okay? And as time goes on, you're going to learn, you're going to get more experience, then that number is going to start going up. You're going to go up to 50% win rate, and then you're going to go up to 60%. Now that is fantastic. If you got a 50% win rate, that is fantastic. 60%, wonderful. 70%, wonderful. as time goes on, you will learn. And your win rate will improve because you're going to add more rules to your trading plan. Now, as you do your back testing, and if you're a new trader just coming across this, then jump over to ICT's channel. And a really good place to start is the 2022 mentorship. That's a wonderful place to start. You got the 2022 mentorship. You have a lot of Twitter spaces from 2022 of the ICT mentorship, which those you can go and you can listen to those. And you can get a pretty good emotional psychology by looking at those videos and listening to some of those Twitter spaces. ICT gives a lot of information, and you should be taking notes during every one of those videos. And you should be taking your time. It's going to take you at least a year to work through the 2022 mentorship. It's going to take you a year, and you're going to work through that. You're going to go practice what you saw in the videos. And if you take your year and you work through that and you finish it, then that knowledge is going to be imprinted into your mind. And you're going to be introduced to a couple of PD arrays. And now once you did the 2022 mentorship, then you can go and you can head over to the core content, and you can go look at the I believe it's month 4 or month 5. And you can go look at, I believe it's, I'm not going to be sure, but I think there's a specific month just on the PD arrays. And you can go look at all the PD arrays, see which ones you resent with, and you take those and you start back testing those specific ones. Now that pretty much covers that for the rant. If you are done in your tape reading, then you move over to a demo for 6 months, and you journal the results, and you look at those results. And that will be the determining factor whether you are ready or not. Now, we were talking about the ICT PD arrays, and you look at those PD arrays and you decide which ones do resemble with you, and you take those ones, and those are the ones that you use in your back testing. And you work with the one that draws to your eye the most, meaning the one that you see the most, you see the easiest. That's the one that you will use. That's probably going to be your model. And you formulate a model with that PD array. Now, you can look back on this channel. I have made a couple of videos with those 2022 ICT mentorship fair value gap model. And I've thrown my own twist to that model. Stuff that I would look for if I was looking to execute a entry. So this, in essence, that would be used as an entry pattern, entry technique with a checklist that you'll look at before you take your entry. And you can take that and you can use any PD array with that. You can use order blocks, you can use inversions, balance price ranges, breaker blocks, mitigation blocks, rejection blocks. You can essentially use any one of ICT's PD arrays with that mindset. And just by looking at the 2022 mentorship itself, you can use that and you can just use any one of the PD arrays that you want in place of the fair value gap. And ICT says himself you can just replace that fair value gap with a order block or a breaker block or whatever tailors to you. That is what you use. And I would suggest if that you take those specific PD arrays, take a couple of them, and you start by taking that back testing and you start looking at trades that would have panned out with that specific PD array. And you keep on journaling those ones, and eventually you will see which one is just the easiest one for you to see. And that is the one that you stick with. And you stay with that one through the rest of your back testing, your forward testing, your tape reading, your demo, as well as starting to live trade. And you become profitable with one model. And when you've done that for long enough and you feel comfortable with that, and in fact, you don't even have to do more than that. You can just keep on using that one model for the rest of your trading career and you're profitable using that. And that's fine. You don't have to do more. But perhaps you advance and you start adding another one of those PD arrays that resembled with you. And then you have to do the same thing. You have to go back. You need to go do some back testing. You need to do forward testing. You need to do tape reading. And you need to do demo trading using that PD array. So if you choose a new PD array and you feel like it also resembles with you, then you have to go back through that whole process of getting a journal filled with these hypothetical trades that you saw throughout your back testing, forward testing, as well as your tape reading and demo. And you journal the results that you saw from those. And according to all of that, you can formulate a trading model. And you can then make a trading plan and approach using that specific model. Because back testing, forward testing, that's going to show you which times of the day that you're going to be more likely to see that specific PD array than other times. And that's how it comes together. And that just answers your questions as you keep on studying and going on. You basically find the answers to your questions that way. Anyway, with all that said, back to the example of the $2,000 and using a micro account And if you keep on trading in that micro account and you go for the 1-to-1, 5 handles stop, 5 handles take profit. ICT's son did a similar thing where I believe he used a 12 handle stop and he targeted, I believe that it was 10 handles, but it could be 5 handles. I'm not 100% sure, but either way, that just showcases that if you do use the right logic behind your trading idea by and executing using the smallest size that you can, and I'll have you know that I'm sure ICT's son knew about the three PD array invalidation rule. So even though he had that stop of about 12 handles, as soon as 2 PD arrays started getting invalidated, then I'm sure that he probably would start being cautious of that trade. And as soon as he lost the third PD array, I'm sure that he would have closed that position as a loss. And it would not have to trade that stop of 12 handles. So there are more than one simple factor that come together and they help you manage your position, which that is more than one factor that line up. And the same thing basically goes with take profit levels. You have perhaps a 15-minute low, and then you have 1-minute equal lows around the same level. And if you plot the fib and you look at the expansion, the projected expansion, then if those levels come together, then that is a logical area where you would take a profit. So there are different types of things that come together, and it's all about getting the experience. It's just experience that will teach you how to do things and how you're going to like to do things or you're not going to want to do things, and you're going to apply your own twist to these things, which that is important. Don't put yourself in a box and feel like you have to force yourself to do things one way. Study them, apply them as you were told, and then you can add small little tweaks. Add your small little tweaks to the model that it works for you. So, all right, let's get back into the video. Let's see over here. All right, looking at last week, we were talking about how we had high news events. And let me get back to the example that I wanted to show you how you would be looking at trading intraday. I was on a 15-minute chart, and I was looking at this specific area, and we were talking about how on Wednesday you would have the FOMC meeting minutes at 2 p.m. and before Monday and Tuesday and Wednesday morning, you would not be really looking to trade anything because that would be more chop, more mess, more erratic price action moves, which you would not be looking to engage in those. So if we look at the week, Monday morning, we blew out the gate. We traded higher. Let's go look at that on a 1 minute. We were referencing this Monday morning, we had FOMC member Waller at 9 a.m. And as you can see, 9 a.m., the market, in fact, did not do much. And beforehand, we were sitting sideways in a MACD consolidation. So if I look at this and I open this up and see this, then to me, it's just not clean. There's not really anything that I would want to engage in looking at this piece of price action. It's just going to be high resistance liquidity run, so I wouldn't expect much. 9:30 market open. Market ran up higher. And we then retraced lower. You can see we traded a fair value gap there. And then tanked off lower. Now, if you look at a daily chart and we look at Monday last week, if we were looking at Monday last week, then we traded inside of this daily fair value gap on Friday. So you would expect expansion up higher for that particular day. I would be expecting a higher price. And you, of course, have to factor in dollar. So let's look at dollar index. Dollar index traded into its daily fair value gap. Closed below weekly inversion. So I would have been looking for a push down below that low. So that would give me a bullish stance on anything other than the dollar would be bullish. That would be a higher time frame bias. But then again, we are in a week where the calendar, we would expect erratic price moves and we will not hold firm to a bias. So let's look at a higher time frame, like a 5-minute or a 15. Sunday to a 4 up here. Need to go back. Really go back over here up to Monday. Is it there now? Or yeah, it's this one. That, or is it this one now? Wait, Monday, Tuesday, Wednesday, Thursday. Okay, so that would be this price leg over here. If you look at this, then you can see we also traded into a daily fair value gap. We already traded that Friday. Okay, that's that daily wick that you see, and then you expect higher prices. This high would be in your scope. So right out the gate, price opens up. Let's go back to that Monday on a 1-minute. Wednesday, Tuesday, Monday. All right. So what happens here is price trades up higher, higher, higher. You have fair value gap, 941. Price trades through the high, another fair value gap, 948, basically 950. That's a macro. 950 to 1010, that's a macro. You still have higher time frame liquidity. Let's find that again. Thursday, Monday should be here. You have higher time frame liquidity, 5-minute old high right there. Let's mark this out. Back to a 1 minute. Let's just jump back to, just use this. There we go. So that's how you would frame that specific session liquidity. Price confirmed this fair value gap. You can see we closed above mean threshold, about at the high of that fair value gap. Took out this low. Traded higher, market structure shift, fair value gap. Back into fair value gap, time of day, 9:50, right about 9:50. Okay, valid entry. Price reacted off the consequent encroachment. Okay, 50% of that fair value gap. So we want to be long. Stop would have to be, we have a fair value gap, but that would be an order block. We have a fair value gap. Stop would be below this fair value gap. Okay, perfect. That will be a 0.06% stop, 3 handle stop, and take profit hypothetically could be at 10%. Okay. And right about there, 2 minutes, 5 handles would be done and dusted. That would be it. And you would be done trading for that specific day. If you were, let's say you had a stop of 5 handles, which is way below this fair value gap and the order block aligned with the fair value gap over here. So these 3 PD arrays would be your barrier, but you give price room to breathe. And let's say you go for 10 handles, which would be around about, around about 20%, 21, 20, right about there. Now, obviously, if price trades higher through these highs, you would start bringing the stop in. Trades through the highs, you bring it in. Trades up closer, you start looking at taking partials at 5 handles. Bring it in, goes up more, and basically hits your take profits. Okay, that's a quick 5-minute little trade. 1, 2, 3, 4, 5, 6 minutes. We're on a 1 minute time frame. 6-minute trade. This would be a classic example of a redistribution of the market maker buy model, which would be a 5-minute market maker buy model. As you saw, if we just bring this out, if it will go back, which it doesn't look like that it will, we can jump into a 5. If you look at this structure, consolidation, smart money reversal, low risk buy, runs up, clears the high. Market maker buy model, classic market maker buy model pattern. And that would be a classic second leg entry. And then it chops its way up to the high. But of course, you only take what you need and you get out of there and you are done for that specific day. Which again, it's a Monday, so you would not always expect this same scenario to take place. So let's look at the calendar one last time. FOMC meeting minutes 2 p.m., 9:30, 8:30 unemployment, PMI number at 9:45 on Thursday. Let's go ahead and look at that one. Now, if this particular one, 9:45 on Thursday, if we look at what I see over here, basically I see relative equal lows, fair value gap. You take all those things, extend them through, extend these fair value gaps through. Let's just do it anyway, because I'm going to go down into that to explain this example anyways. That gap would only be that remaining portion of it would be open. Since we already traded into this little bit of that gap, that's the remaining part. I'm just going to leave it as is. It's below that 15-minute equal low, so we know that it is this little gap. In this particular example, we would look at a, let's go down and see what the lower time frame offers us to take a short. And another nice, very nice confluence in this specific case would be this 15-minute. That would be a inversion. So that gives you a confluence. Price traded through it, back into it, down lower, back into it one more time, and it obviously moves down lower. So that gives you a higher time frame level to trade into. Let's take this back to Thursday around about 9:30. Yeah, let's look. Okay, so looking at this, we trade through. There we trade back into it. 10 o'clock. 10:39, 10:40. Since we would expect to see a reaction coming back in this level, let's look at this little piece of price action, this 10:45, and then let's say we would be looking at the 10:50 model. Now, you would be looking at that. See if I can bring that up, extend it through. So we take that high, we clear that high, we clear that buy side liquidity. See that equal high right there? We take those out. Take it again above this high. See how we're sitting inside of that fair value gap. See those two candles right there? Order block. Notice that we also have another fair value gap over here, just like in the 2022 mentorship, which aligns. Okay, see that? There's the order block. All right. And then price comes into that second fair value gap, 1045. That could be a potential entry. You would target the lows. So if you took this short, let's say you took the entry there, the stop would have to be above the high of that first fair value gap candle. It's going to have to be there, or it's going to have to be above the fair value gap. Okay? Take profit at this low. Equal lows, equal lows. So if I want to hold it through for this low down here, then this has to be a partial, or I need to take a partial over here. Okay, partials pay. Price starts trading down, immediate reaction. trades down again, trades down, shoots down. Take partials. Start trading down, you take a partial right there. Right there, you take a partial. Trades down, take profit. Okay. That would be one entry or one scenario. Then you have another one where you would be able to look at the 1050. See that? Fair value gap. This one's going to be complex. You're going to look at that wick. Consequent encroachment of that wick, 1052. That's an entry. Trades off lower. I have to go look for targets. Go up to a 5. Let's note this gap. Let's go back to 1 minute. All right. 5-minute gap. Let's say that you took this entry. As soon as it trades that consequent encroachment, you're in. Now, that would be a breakaway gap. How do I know it's a breakaway gap? We can take the fib. We were expecting, you sat down 1030, saw this move happened. Frame your range. Let's say you were looking up straight up to that fair value gap low. That gap low, gap low. Around 50%. You're going to get your breakaway gaps. So around about 50% breakaway gap. Let's just remove this fib. Keep things clean. All right, I took an entry over here. All right, so I got a wick. I have a fair value gap. And I would also look at high, low, higher, high. So that's a breaker block right there. So wick, fair value gap, breaker block. Stop has to be at the highest one, which would be the breaker block. That's 0.08%. It's a 3.5 handle stop, just about. Targets, we would be looking at consequent encroachment of this gap would be first take profit, which that would be about 5 handles. And then low of the gap could be used as a second take profit. And that is about 7.5 handles that you're looking at. So that is a viable trade entry as well. And that one would be framed using session liquidity, because we were targeting those 15 minutes We were targeting these 50-minute equal lows as well as that gap we saw. All right. So looking at live price action, that would be the idea that you would use. Obviously, in hindsight, we can see that price traded up higher. Lunch, we just chopped around. Not much to see. We can just extend this through. See how we chopped around that. Now we can look at this price action. 1250 macro, 1250, 110. That is a macro. You look at this fair value gap, extend that through. We trade it into the low. Target is going to be all the way down there. 15-minute equal low. We could also use that 1 minute old low, extend that through. We also have this fair value gap. That's a wonderful area to extend through as well. So we extend that through. We can see that traded right there. Just ignore this one for now. We can see that traded right into that. See that? Candle closed above the mean threshold at that 5-minute gap. All right. In this case, we have a failure swing. We have gap right there. Gap right there. Whole bunch of down candles with gaps. Little gap over here. But notice that we market structure shift, and we had a very volatile move down. We had a propulsion. It moved with a lot of propulsion down. So this would be a valid fair value gap. Fair value gap. Price traded into it. For confluence, we could look at that fair value gap over here, which that would be a inversion. Look just how neatly that just about almost misses the 25% of this fair value gap. And then another thing that we could look at is these two down close candles. We could use them as a reclaimed block. And the reason why I say that is because right after these two down candles, price moved away quickly with a lot of expansion. Price came back to it here. They mitigated those shorts, those longs. They mitigated the longs. So that those levels would have confluence behind them if we trade back to them. So we trade it through. So we have that inversion. We have market structure shift with propulsion, fair value gap, and we have a reclaimed block over here. So that gives you your 3 PD arrays that would need to be invalidated. So easy enough. This was a institutional order flow entry drill. Let's say that we took it right there. Stop would have to be above this high. It's only 0.10%. If you're managing the risk properly, then that is not a lot of money that you are putting on the table. Take profits. Now, before we look at take profits, let's pull a fib on this price range. From the high, I'm using candle bodies in this example. High to low. There we go. Let's just pull it back a little bit so it doesn't cut it off. Pull it back right there. So that grades the price swing. This is another good, even this one is a pretty good fair gap that we can extend. That one. Pretty good. You can see we had reactions. We had a pause inside them. And they're right around the 50% of that range. So we can expect a pause. I hope you're writing it down. So we get a pause over there. It's almost at the 50% breakaway gap. First, take profit. This fair value gap is beautiful. That's a nice take profit. If you didn't take anything there, this low coupled with this fair value gap, as well as the consequent encroachment of this 5-minute gap, that's a beautiful target. 22%, 10 handles with this macro, 1250, 110. That's a nice trade. And we stab into this fair value gap down here as well. And you wouldn't be holding through this anyway. So that would be it for that particular trading idea. So we can take a fib. We can pull the fib. Would pull the fib from this high down to target, which is pretty much going to be the equal lows, really. But we could pull it down to the low of that fair value gap. Just ignore this level here. That's not going to be used in our example. So again, we have that 5-minute gap, and this is just a 1 minute. We can just delete this. It's not of significance of us for now. So now if we look at this, then we still have this 15-minute. Let me just pull this back. 15-minute equal low coupled with the 15-minute fair value gap. So we know that we already have rejected. We've moved lower. We've closed below this 5-minute gap, indicating lower prices. We moved below this low. So now we are starting to shift. We got another market structure shift with propulsion behind it. So then again, let's see what is this? 1340. Potential trade, perhaps. Potential trade. It could be. It's got this fair value gap right here. Traded through with propulsion, comes back into it. That might be a potential trading idea. If you didn't want to take that, then what you have, if you didn't take it, then very similarly to the previous examples that we looked at, where you had that sell, where we looked at that market maker buy model, this could be viewed as a market maker sell model, okay? And that would be This would be seen as a first stage sell-off. And then we could see this as a second and a third stage sell-off. And this is 150. So 150 to 210 is a valid macro. So we're really focusing on macro times, specifically because we're looking for the volatility to come in around the macro. So that's what we're looking for. We're looking for that idea to back us up. So looking at this idea, we would still be above 50%. So we would still be in a premium. Okay, because beforehand, that this is your expected target, all right? So that's what you frame from the high to the expected low, and that gives you a range, a premium, and a discount to work within. You see, this was formed at the 75% of the range, the upper really deep premium. So that could be a confluence. You can say we have had propulsion, we had a fair value gap. Look at how price traded to the consequent encroachment, immediately closed right below that fair value gap in the next candle. It even came back up here and offered the low and traded down lower. High, low, higher high. Breaker block, last down candle. So breaker block, fair value gap, traded through with propulsion. We traded from a 15-minute inversion, traded through a 5-minute gap. That is a valid entry to take a short in a premium. And if you did not feel comfortable taking it at 140, which is perfectly fine, you wait for 150. Now you have all those confluences, that breaker block, the fair value gap, traded with propulsion. It's off the heels of a 15-minute inversion. Traded down through that, traded through the 5-minute gap, respected this 1-minute gap lower. We still have all this range to work with. So there is nothing wrong with expecting an entry over here. We're still above 50%. We're still in a premium. So 150. Let's get the short tool. We trade into it. Close right below it. Trade into it. Couldn't reach the 50%. Close below it. Let's wait for 150. 150 comes in, trades back into it. Let's say you took an entry right there. You thought that it was going to trade into it one last time and then give up the ghost. In this example, fair value gap, order block, fair value gap. Your stop can go right above that fair value gap. In this case, we can see that is a 10 handle stop, which would be one of your bigger stops. If you use proper risk management, that would not be a problem. Suck it up, buttercup. Take profits. You would be targeting that 15-minute equal low. As you can see, that is still a 1 to 2. And in this case, this was a 20 handle run. We can see that price immediately started running lower. You sat inside that for 1 minute, traded up higher, gave up the ghost. Bam. 50%. Fair value gap. Institutional order flow entry drill. Breakaway gap. Why? 50% of the range. Put it down lower. Fair value gap. Institutional order for entry draw. So as you were inside of this trade, price kept on confirming and showing you the signs that it wants to keep on rallying down lower. Now, you could take a partial at 0.25% of the range. That is a valid discount level. That's valid take profit level. Take something off, which is still a 1.5% gain. Take something off there, and then obviously as price runs down, rejects this, starts running down lower. Obviously you can take your stop when you bring your stop down in lower, runs down, rejects it again. Stop would then be at cover costs and commissions. Okay, break even stop. And then if you kept on targeting this equal low, then you can see prices rallying. It's starting to dribble down. Even after hitting this fair value gap, it starts dribbling down. Right about at it. Trades higher, goes back down, comes back one more time above this high. Finally gives up the ghost and hits your take profit. So a beautiful area to take a partial would be 0.25%. Take a partial off, reduce the risk, and if you wanted to leave a runner, then you could do so. And that would be that particular trading idea. Let's get rid of all these now. So that is how you would look at trading that intraday intra-session volatility. That is how you are going to do that.